Hello, folks. Welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Okay, so interesting day under 5,000 on the S&P, but back above it, under 4,900. Official bear market has happened. Can check that one off. Down more than 20% from the all-time high. Just some standardized disclosures and return important information disclosures. I will also share with you the standardized returns of some ETFs that we're going to be looking at, where I put some stuff into the chat as well if you want to see the prospectuses of some of those same ETFs. Now, we use those ETFs just to look at the sectors overall. They're not necessarily any kind of things that people would want to trade necessarily. These are the standardized returns, and I'm going to actually turn off the data here because sometimes, let me just turn that off anyway. Sometimes when I'm live streaming, having live streaming data just causes things a little bit tricky. So basically, these are standardized returns. I want to just start off by showing a few other things very quickly on the TradeStation platform because it is interesting to actually look at some of the overbought, oversold conditions. This is, excuse me, a workspace that we created some time ago, and it has a few various sort of indicators in it. But essentially what they do is it shows the distance from a given moving average. Now, this is a 4-hour chart. What it does is it has a 50 period moving average, and then this is basically the distance from the moving average, the current price. So if you look at this, I mean, historically, I mean, this is the farthest, I mean, since we get back here to COVID, okay? So you can say in this case that by this measure, we're the most oversold in a long time. So all these are pointing in a similar direction. I'll just mention that. If you look here, um, also on the RSI of the daily chart, this went to the most oversold since COVID. Interestingly, the NASDAQ went to the most oversold since even before COVID, and that was an interesting thing to notice is that the Nasdaq actually during COVID held up relatively well. So that's just kind of interesting. Now, also let's take a look here. Um, I'm just going to say right now that I kind of came in with this idea of buyers being on strike. But as I look overall, I think we're also in a spot where we have to almost start to wonder if maybe more the title of what I would be doing today would be whether the pushback is maybe going to start to come now. Are we going to face, is the pushback already starting? And maybe that's more the narrative to think about, or the expectation, the market pricing in a political pushback against the tariff situation. So I turned off the data, but this data is accurate as of a minute or two ago. You can see today, technology, communications leading, semiconductors leading, NASDAQ leading, growth leading. So this is what you want to see if you want to see the market bounce. You don't want to see outperformance in utilities and healthcare and consumer staples, and we're not seeing it. So this is overall, I think, to me, the beginnings of some signs here that there is a sense of people saying, you know what, there's a lot of risk out there, and it's pretty much pretty well expressed in where the market is overall. So one just show you things on TradeStation that I thought were important. Now, let's actually look on a year-to-date basis. I'm just curious about this. Every single sector is negative on a year-to-date basis. The best performer is consumer staples with a minus 0.6. So that really tells you something. All right, now let's go and hide this and let's look at our trading view charts. And these are the main things we kind of look at. Now, before we even get into these, I want to just quickly zip through a few points I thought were interesting. Now, if you go to tradestation.com, a lot of things I'm talking about, are kind of in this blog post. If you go scroll down here, you can see this blog post here. Tariff stunner puts stock buyers on strike. And I thought it was an interesting way to think about it. And I said this before. I said that in many ways that people would be, potentially just stepping away from the market completely in this environment. Buyers kind of going on strike, and because of the uncertainty. And I said we were going to see more negative news on earnings and all that sort of stuff. But now we have gotten a flood of this negativity. And if you actually look, we actually documented a lot of it here. People like Paul McCulley, different sort of strategists and stuff. And there's a lot out there. If you look, it's not hard to find people saying that tariffs are bad for the stock market. So that's been happening. And I think one thing is, when you anticipate something and it happens, then you have to say, all right, that happened. And then you don't want to necessarily be pushing on a string. You want to say, what's the next thing to start to happen? And I think right now we're in the spot where people appreciating that there's a big risk, it's bad for earnings, it's bad for the economy. Now the thing is, what's the next thing that will be on the newspaper? If you fast forward the headlines 2 to 3 weeks into the future, what do we think is maybe something that is more of a potential thing that would be the those events that could be unfolding? That's how I try and do. I try and think it's 2 to 3 weeks from now. What is likely to be in the news? And as I look at those things, I think that that's how the market kind of thinks as well. So the thing is that at this point, when you look overall where we are in the S&P, we have pulled back near the highs from 2021. We've gone below the bear market level. We also pretty much came very close to retracing the entire move from the low of 2022 to the recent high. So all these things have now happened. We basically are now trying to hold somewhere back here around early. There was a price level in the S&P 500 when it kind of broke out back here on the weekly chart in early last year, early 2024, more than a year ago now. And that level was the level where we opened at today and where we basically held. And so I'm sorry, the level that we went down was the low from January, and then the level that we're trying to hold is a level from late February, early April of last year. So that's all kind of so you can see across here, there are some reasons here. There's a lot of potential things in place. The high from 2021, the low from basically January, February, or there was the breakout point of January 2024, and then also at a higher spot, the level from late February, and you can see it here, late February and early April. So these sort of levels where we opened and where we've held and moved higher from, plus the 20% bear market and the 50% retracement of the longer term move from 2022. So the thing is that these are all levels now where it kind of says, I think people can say we've priced in a lot of a lot of negativity, and even if things don't get better instantly, to a certain extent, it's now more the onus is now more on the bears to prove that we are going to actually have the Armageddon scenario. And the thing is, maybe we do have the Armageddon scenario, but the fact is that maybe the market says we'll give it the benefit of the doubt for a week or two to see. And I think that's a spot where we're kind of in now, where things can get worse and we could have all sorts of problems, like people say, recession, all that stuff. But the point is also is that a vast amount of that negativity has already now happened, and now it needs to be proven. And that's why it puts us in this spot of, people are more likely to say it's going to get better from here. Even if it doesn't, if it is going to get worse, that decision will be made at some point in the future, maybe not today. And I think that creates more of a potential here for some bounces when we combine it with those technical things like we mentioned, the extreme oversold conditions, the RSI, all that sort of stuff. So I think it's important also, let's see, and I'd also say that in some ways technicals here are at a spot where the volatility is much higher and individual levels and things even are also kind of harder to kind of exactly stand by. Although a level is emerging this morning. In fact, this is one other thing I want to show you here in TradeStation is 49.50. Look at I outlined it on the hourly chart. This is the MTES chart that we use. This chart now is I think if we have bottomed, I would say this chart, the hourly that I've talked about other times, is not as useful. It has had some given some nice signals, but this is also something here we just be careful of. If we have bottomed and we do see more of a rip to the upside, something like this might not be useful at the exact moment. But if we get to the point when the 50-hour changes direction, that's when maybe it gives us something. Now, but the key thing I wanted to point out was 49.50. You can see basically that was where we opened. We rallied above and we held, right? And basically been making higher lows above it since. We are pushing above it now around 50.90. So overall, this is, I think, an important thing also to kind of realize. Now, I want to just get into some of the other things I think are important here. One of them also is just very quickly to mention is that gold is actually weaker today. It had tried to rally and it's back under 3,000. This is potentially a positive sign. So I think this is also something that might be, kind of a good news thing if people are looking for, it's a positive sign if you want to be more on the long side. Just kind of point that out. Now, there are some things I have to very quickly cover before we get into the individual levels, because there's a lot in the news and I want to kind of put it out there. First of all, there's talk about things like credit risk. And I think it's important to realize credit spreads have widened. There is a certain amount of conversation about risks of things blowing up in the credit market. And in my view, that's something that we're kind of potentially getting toward, but there's not the confirmation of it yet. I think the thing is, if jobless claims are over 300,000 or 400,000, then it would be more of a risk. It's kind of like you have a bunch of undergrowth in the forest and you think there's going to be a forest fire, but you know what? It's been raining or it isn't dry enough. And so, yeah, it might be a risk, but it's not ready to catch fire yet. And I think that's the way to think right now about the credit market. There is this huge growth of private credit that we've had, and it's grown since the last crisis. And it seems to be performing well. Everyone says it's this great new asset class. I don't know very much about it, but it's one of these things that it has not yet been tested by a true crisis or a true recession. And so I think that is something that's out there. It might be a bunch of undergrowth on the ground, and maybe it never catches fire, but it's out there. But at the same time, like I said, with claims still well under 250,000, it's hard to really see a huge contagion in the credit market yet. I'd also say that well, the other thing is interesting is that we are seeing a little bit of a thing where they are now forcing student loans to be repaid again, and that creates some risk. But again, jobless claims under 250,000, not these are all risks, but again, it's not yet to that point. So the labor market is interesting. Now, as I talk about the labor market, it's important to realize that I think we could say that this environment now is the anti-Goldilocks environment. Jobs are too strong for the Fed to want to cut, and inflation in some ways is still menacingly, there or high enough to keep the Fed from cutting rates. But we're not doing so great that profits are going to go shooting higher, and that creates a real problem. So you have an environment where the good news in terms of profit growth and all that stuff is very much in question. But the bad news, at least bad news if you're looking for rate cuts, the bad news is potentially quite strong. High employment, low unemployment, strong jobs, and at the same time, relatively high inflation. So this is now the opposite of Goldilocks. And I think we kind of have to realize here is that there is, I think for the first time, I think I can actually say this in a long time, we might be entering a secular bear market. Now, that doesn't mean that the market's going to just go straight down forever, but we might be at a spot where new highs in the S&P are not just a given. And from my view here, it depends on how significant the real trade disruption ends up being over the longer run. And the reason I'll say that is that, in my view, a lot of the profit growth that we have seen for decades has been based on globalization. The entire executive leadership class of the United States and probably other countries, especially our country, is based on global supply chains. And it's kind of like an animal that has a tooth that's shaped a certain way to eat a certain kind of grass, and then suddenly it has to eat a different plant. It might not be able to just adapt instantly. So I think the thing we have to realize is that our our system works a certain way, and it's based on globalization, for better or for worse. And if you just yank that away, to assume that the animal just adapts to a new environment is not necessarily the strongest assumption. And even if it does happen, it could take a long time, and that could be, also something that is a negative for profit. So we could see the economy be strong and corporate profits struggle for a prolonged period of time. And I would say what's interesting is that if you went back to the period of time after the dot-com, between like '03, the bull market of '03 to '07, people call that a jobless recovery. And we might face the opposite of that now. And in my opinion, that was caused in many ways by globalization and the implementation of technology. And that resulted in higher productivity, which resulted in less employment. People were able to get jobs done without as many workers, and that was good for profits, bad for employment. We could have just the opposite now, where basically we're going to see, you know, profits may struggle, at the same time unemployment remains low. And it goes against what a lot of like doctrine might say, but I look at data, I look at trends in the data, and when you look at where ISM manufacturing has been, and you look at the fact that jobless claims have stayed under 250,000, I mean, that is not what the textbooks say should happen. We're in an environment now that is positive for jobs, but not necessarily positive for profits. And so that is also, I think, something we have to kind of look at and see. Nonetheless, a lot of bad stuff has been priced in so far. So it also mentioned that there is some risk. Nouriel Rubini did an interview on Bloomberg over the weekend. He basically said that China has the dry powder to escalate this trade war against the United States more than we have the ability to push back. They have more fiscal ability and everything else like that. That was his opinion. I don't know if he looks at these things. And I look out also now, and I think we're in a spot where, I don't like to get into politics, but I have to look at the things that impact the market. And I would say that now we're in a spot where the political things, on one hand, you can see the potential for political clash between the White House and Jerome Powell. And that's something I've seen as some risk, the risk of China escalating. Those things are out there as these kind of scary scaries. But when I look at the things that maybe seem more substantively happening, I look at several interesting things today. First of all, I look at a growing number of congressional Republicans questioning tariffs. Trump apparently has to actually now threaten to veto any actions they might take. So again, that's the beginning of it. First it was 2, then it was 5, then it was 7 congressional Republicans pushing back on it. The other thing important to realize is that Trump is now a lame duck. And the main focus, if you're a Republican in a swing district especially, is the midterm elections next year. And the other thing is that yes, there might be people who are big pro-Trump people who they are afraid of Trump going against, endorsing against them. But what do you have on the other side? You have businessmen like Bill Ackman, Larry Fink, and Stanley Druckenmiller. These guys are all basically now criticizing the tariff position. You have a report in Reuters today that Jamie Dimon and 4 other bank CEOs, unnamed, it's an when these sources say, article in Reuters, that they had some kind of conference call with President Trump. So you're seeing the beginnings of this huge consensus of Wall Street and other mainstream economists pushing back on this. Over the weekend, we had something else from various apparel groups saying you're going to see huge spikes in apparel and clothing prices. So this is now something where it's not just a few partisan anti-Trump people criticizing this. This is a growing mainstream consensus, and you're seeing evidence of some of the Republicans starting to jump over. You can also see the lame duck status of the president and the fact that the midterms are coming. So all these may create the potential for the pendulum to swing the other way, and it could be something happening in the House. It could be a court decision. There's now multiple lawsuits from different trade groups challenging these tariffs. There could suddenly be an announcement, some court orders the tariffs halted or whatever. And then, or it could be certain Republicans jump over and join Democrats on a resolution against tariffs. So all these things are now out there as potential. And that's what I'm saying, when we're this far down and there's so much negativity priced in, the risk might be that there are signs of pushback coming together, and that can create more of a sort of rebound potential in the market for the time being. Now, again, all these things for me are very much for the time being. It is possible that we get some degree of rebound, but then we come back and we realize, you know what? The profitability still won't come through. Valuations are still too high, or something like that. And I think that's more where we're going to play. And if you look at a secular bear market, and I don't mean to be too scary about that. But what I'm saying is it in a secular bear market, if you look at things like the 1970s or things like that, the market didn't just go straight down. It was basically range bound for a long period of time. And we could be entering now a longer term range instead of this continuous upside. So that's just how I want to kind of lay it out there. I've never used this term before, at least not that I can remember. So I think, some of it makes sense when you put the pieces together. Now, as you look at the events this week, like I said, anything could come out politically to surprise people. There is a CPI and the PPI report. CPI is on Thursday. We have Fed minutes on Wednesday afternoon. Those could be some events that I think we have to be aware of. But the Fed has pretty much expressed itself here that they are against these tariffs. They're not going to go and just cut rates to make the world a better place for stock buyers and for the White House. They are going to fight inflation. And why? Because claims are under 250,000. Until we see unemployment go over 4.5%, 5%, the Fed is not going to, at least from what we can see, the Fed has laid things out pretty clearly that they're going to focus on inflation, and they're not going to just be cutting rates to make things easy. So we're inching in a more hawkish direction. The other thing I want to mention is that I just think it's interesting to think about, if you look historically, apparel and clothing and footwear have been getting cheaper for the last 30 years. They've either been falling or stable in price while other things have gone up. So I think it's important also to realize the idea of massive tariffs on Vietnam and Cambodia, these actually threaten to change structurally our inflation picture. And I think that that is something people do need to think about. If this really becomes reality, you know, Americans have not really we've gotten accustomed to cheap clothing, and I think we just have to realize is that if these tariffs remain on Cambodia and Vietnam, that won't necessarily continue. The other thing I have to realize also is that we could, if you're in auto insurance and you look out as policies renew, if these insurance companies see car prices are going to be materially higher, we might start seeing this structural inflation occur in those auto premiums. Other kinds of insurance have, these are lagging kind of sticky forms of inflation. And we've hoped, that the base effect of things working their way through, that these would start getting more negative as this year went on and be more disinflationary. So these tariffs create the risk of things like structural cost, prices in apparel and insurance that are these kind of under the radar stuff that you don't want to think of. And if you have to think about them, it also just creates this kind of negativity and fear of inflation. So those are the main things I'm going to talk about before we get to the index here. So here, S&P, like I said, basically holding these various levels. And so from my perspective here, I'm kind of looking to the upside and saying, if we rebound, where do we go? And, from my view here, 5,400 from September, it was important. I thought it looked like it could be important, but we just completely blitzed right through it. Nonetheless, it could be a point to look for it. There's a lot of levels across here, and honestly, right now, something I have to say as I look at this, I'm not sure which ones really are the first point to really look at for the for a potential peak if we do have a degree of a snapback. So I'm just pointing out that you could look to these levels from late July and early August around 5,300 or 5,310, and then kind of the 5,400 level from September. There's a lot of different levels here, and this is why I would say that the MTES, this is a sort of thing where if we get back up to some old highs, this is when the signals on here can start to matter. But I'm not exactly sure where I would say at this point would be a logical stopping point on the S&P itself. Now, if you look at the Qs here, what was interesting to me, and actually the S&P, I think the most important thing though I want to say right here is that the April low, this level right around 49.53, which is really close to the 49.50 level we were talking about. That level, I think, is really the main one. And if you look at our article that we did here, we actually did emphasize in the article this level around 49.54. See, this was the level we talked about in this article. So from my view, that is really the one here, that holding this is the thing here that's most important right here at this moment in time. Now we go to the Qs. Same thing. This kind of weekly low from April is in play. I'm not going to pull it up, but the RSI on the daily chart is the lowest since October of 2018. So that's an important thing. Also, it's interesting. We had talked about the SOX, the semiconductor index. Wow, look at that. We had basically mentioned that this had that risk of, wow, I had not actually looked at this. I just I wanted to circle back to it because last week we did talk about it. And so but this one did break that important low. But now, I mean, it's at a spot where, I mean, technically this is less important now, but we did emphasize we sat under it for like 2 days on the daily. If you look here in the daily chart here, I was actually, let's see, the daily chart here of SOX. You can actually see that the level we were looking at was the level basically right across here, and you can see that we basically went down and sat under it, and you can just see the incredible acceleration as we broke that. But the Qs here, I think the most important thing is basically that we're also holding the April low, and from my view here, there is a lot. Again, it's like the S&P. There's a lot of levels to the upside here, And the first stop for me to the upside would probably be looking back to the September low as well. That's the one that looks the most kind of apparent. Because also with this one, unlike some of the others, you can look across here and actually see that that September low in some ways actually goes all the way back here to March as the old high. So it was resistance, and it became support, and then it became resistance again. You can see there's actually kind of a few different levels there. So this level here around, I'd say kind of 448 on the Qs is the level that kind of grabs my attention here as a potential one to watch. Now the Dow is also here, I think, trying to hold these levels. And uh-oh, let me screen back. Anyway, from here, at this point, the one that stands out to me is also, if you look at the September low and the high from last spring on this one, it's right around 40,000 on the Dow. The Russell here is really in a spot where a rebound back to those April lows is probably what people look at. It's interesting. Everything else is above the April lows. The Russell is below the April lows. So this might be something where we see a little bit of upside, some stabilization for a couple of days, but then potentially continuation back down toward the lows from 2023. Now, the one that remains kind of most noteworthy to me is the 10-year Treasury yield. And we actually did a trading view idea on this today. And it was basically noting that the 10-year Treasury yield really has not pulled back that much when you consider the magnitude of the sell-off in the S&P. My view here is that there's another reason why I do see some risk of there being a longer lasting weakness in stocks, which is essentially that the 10-year Treasury yield appears to have, on a monthly chart, you can see here that it had broken this downtrend that goes back really to the early 1980s. And if we do have more kind of inflation, this is something that is you know the upside could continue. So from my view, this remains potentially the most important chart. And I think that the S&P can bounce here for a bit with Treasury yields moving higher. But the thing is, and I think the biggest risk that we actually face is over time, maybe the next week or two, the stocks kind of have some degree of rebound, but then the 10-year really moves to the upside. And then we're back in a scenario like we were in basically in the summer of 2023, when things were great and then the yields started moving higher, and then the market basically started falling into October of 23 when we started rallying again. So the thing is, I think we have to realize here that another move to the upside, and it's interesting to see this pattern, this high basing pattern, above kind of 3.8, 3 3/4 on the 10-year. This remains, I think, the most important thing to watch. Um, Now, look at the materials, XLB. This is now going down, and it's holding the level really from kind of like that October here. And I would say from here, this is actually one where people might actually look for a certain amount of a potential for a rebound here in the materials. Communications remain, this very strong part of the market. And here we are trying to hold a level from last September. And it's interesting that other ones are below their September lows, and that basically the XLC communications are holding it. From my view, this remains an area when people look at that does not have that same degree of tariff risk. It does have the mega cap risk. It does have the fact that there does seem to be a certain amount of unwinding of U.S. assets and money kind of just moving away from the U.S. stock market, and this is a big chunk of that. Nonetheless, this is an area now where I think we have to kind of see that it has pulled back substantially, and people probably view it as an area that has less real kind of risk here of the of tariffs. The other thing about it is that we're more or less holding those old highs from all the way back in 2021. So this seems to have kind of multiple areas of potential support here. XLE. Now energy is one that this to me is actually something that's interesting, because last week we got a lot of bad news. OPEC basically, excuse me, OPEC increased oil production, and this took, a lot of that bad news is now priced in. So I think you might want to look and see here if energy can manage to hold this low from back in March of 2023 here, for me, this is also something where people might look for a move back up toward kind of 83 on XLE. Now, financials are also interesting because they did not even go down to their their lows from last summer. Financials, don't forget, start to report earnings this week. So, from my view here, seeing financials hold this level, there is a risk now that the financials report decent earnings because they've been on a solid trajectory, and there's a lot of now pullback priced into this. So I want to point out here, if there's any area that may have the kind of the most potential in the near term, it may continue to be financials and communications. Those two continue to have the healthiest weekly charts. Now, the industrials XLI. Now we were really wary of this one, and it really did kind of pan out as we saw the risk in this. And so I'm going to actually remove here. We had that. Look at these. I got to remove these. This stuff is ancient history now. From my view here, I'm not sure what to make here of industrials. I would say in some ways, though, that we're basically seeing the old support here right around 119 that went back throughout last spring that we're now below. And I think we have a zone across here. So I think between like 113 and 119, 120-ish on XLI is a kind of prison cell for a time being. And this one has a lot of, I think, fundamental risk when you look at things like tariffs and potentially slower economy and things like that. So from my view here, XLI remains, one of the areas of the market with maybe the most, more on the risk side. Now, tech also has kind of pulled back, trying to hold levels from late 23. And, I think it's also important to realize here that if this were to rebound, we do have some potential levels that go back to kind of last year around more or less 192-ish, kind of from April of 24 and August of 24. It's where we peak today, and that might also be the level people look for more of a move toward that, and kind of if nothing more bad happens, that might be an area where people look for it to kind of go up, and kind of if it is going to stall, that might be where the selling pressure is on XLK. It's also, I want to just mention that Samsung, which is not in the United States, but they did cut their guidance on. They saw weakness in the AI demand. Consumer staples continue to kind of hold these lows, and this is an area will probably, where people might just kind of see it sit for a while. But seeing it weak on a day when the market is trying to rebound a little is also potentially a good sign of people looking for some risk appetite here. Now, in terms of real estate, this to me remains now a problem because of what I said about treasury yields, and I think this might actually be an area now that gets more kind of constructive to the downside in a longer running way. We tried to have the strength, and it didn't really work. So I think these are now on in a pretty difficult spot. Utilities may be in a similar environment. These are now trying to hold some levels from kind of back here last summer, from kind of June, but also with the risk of yields moving higher, these may also be in a bad spot where this might turn into a false breakout up here. So I think right now utilities are kind of you know they they might end up having, it's not to say they have significant downside in the near term, but there is potential here of this channel forming, and of us seeing risk of yields moving higher, and of people saying, oh yeah, maybe the whole AI thing wasn't as amazing as we thought, or maybe now there's going to be some of these nuclear plants or whatever be kind of maybe scaled back or something. So they're now in a spot where there's a lot of good news priced in, and the macro environment of higher yields are not great for them. Healthcare also in a spot here where it's really failed to hold any kind of levels here. And the thing is, if we do see a little bit more of a risk on environment toward growth stocks, um, uh, this is also something where the macro would not favor it, and it does have potential risk all the way down to 122. And consumer discretionaries here, I would just point out that at this point, people might look to the levels from April of last year, kind of around 169 area. But this is also something here where it is part of the large growth area, and if there is a desire for the overall market to rebound, then we might actually see an attempt to go back and test these levels from back here in March. In many ways, this led to the downside, and it may be in a spot where most of the selling has occurred for now. All right, so I'm sorry I ran over on time. We will be back for market trends on Thursday afternoon at 2 p.m. Eastern. I hope everyone has a great day, and I'll see you then.